Investors are now widely expecting the Federal Reserve to lift rates by 25 basis points or a quarter percentage point at its Federal Open Market Committee meeting. Many now wonder what implications that could have for markets as well as the economy in the wake of Silicon Valley Bank's collapse, and whether a hike during this financial turmoil increases the odds of a recession. Joining now for more on what the market's technicals are suggesting is Fundstrat Global Advisors Global Head of Technical Strategy, Mark Newton. Mark, thank you so much for being here. You definitely have brought us some charts that we should be watching here. Where do you want to start? What's the sort of foremost in your mind as we go into the Fed meeting?
Well, look, Fed days are always extraordinarily important, and an increased level of uncertainty, I think, today, because we really only have about an 83% chance of the Fed hiking 25 basis points, which is a lot less than we've seen all year long. And also, we know that really, the average movement is about 1.9%. Obviously, Powell's comments are increasingly important in really helping to shape investors' expectations. And so, that started during their Bernanke term back in 2011. So, obviously, a lot of volatility. We've had a big rally, about 200-point rally in the S&P since March the 13th. S&P is now up to what I believe is very important, sort of make or break levels for the market. Big move in technology. That's really been the area that's carried, the majority of the market. And of course, the most important being 27%. So it's going to be important to really see if the market can really follow through on this and see other sectors really start to help to carry the load outside of just technology.
Okay, and so we don't want to kind of belabor some of the charts that you've been looking at and the technical analysis here. And so you believe that stocks could take off this year, but within this, of course, we have to factor in a few things, one of which you were just walking through, falling interest rate expectations being a positive there. But then what else would you be keeping an eye on here?
Well, look, I think the consensus is right now that the market has it wrong, and that's really interesting. Everybody is really talking the same playbook that, earnings revisions have to continue to drop, that the Fed is going to hike us into a recession. There's a lot of doom and gloom for probably a lot of the right reasons. However, as we heard from Soros's famous protege, Druckenmiller, the economy of the stock market is the best economist I know. So, we really should be concentrating on levels of sentiment and what sentiment is teaching us about what investors think, rather than really debating whether it's going to be 25 basis points or zero. The labor market remains in very good shape. This is a very different economy than any of us have been used to in a long time. So we can't really use the same playbook to say that, we're going to have a recession or not. And you really have to follow really what the market's telling us. And the market has had a very good start to the year. Now we've had about a 6% drop from early February. However, technology has outperformed any other sector over the last month. It's been the number one sector. And we're starting to see some evidence of financials now. The banks are stabilizing. Healthcare, I sent you a chart on healthcare. I think that's important. That's the second largest group within the S&P, and now that's starting to show evidence of trying to stabilize and move higher. So this is a chart really of equal-weighted healthcare versus the equal-weighted S&P. So when you see these stocks within groups like medical devices and biotech starting to gain ground, that's a really important thing to concentrate on for investors, because that's a very, a very heavy sector within the S&P outside of technology.
And, we had up a chart of the S&P 500 year to date with some of your technical mapping on there. What can you walk us through what these lines are and what we should be watching, what all of this indicates?
Well, those of us that use technical analysis, we're apt to really draw trend lines connecting, the highest high to the high that precedes the low. Bottom line, you want to get an understanding of trends. Are the trends moving, up, down, or sideways? And so, the market's had a great bounce since last October, but recently we've been in consolidation mode since the beginning of February. So that upper line really is what a lot of investors consider to be trend line resistance. And in order to expect that this rally is going to continue, we actually need to get above that. That would provide, some firepower, some energy for investors to either climb on board or for shorts to be stopped out. And that will allow, the market continue to rise. But normally, having a sharp 200-point rally into a very important level, that's normally a time also when you could see profit taking and see a pullback. So, really a make or break, as I discussed, for regards to the S&P at this level, because we've had a decent bounce. And now, the key is, can financials and the banks continue to, bounce at this point? And we've seen some evidence this morning that a few of them are under pressure yet again. And can healthcare continue? So technology being 28%, financials and healthcare are both about 12%. So that's over 50% of the market right there in just those three sectors. So incredibly important for investors to really understand the sector rotation and what's happening.
Mark, you also have a chart particularly tracking the 100-day moving average of Bitcoin. And Bitcoin, we know, has kind of broken through some of those resistance levels. And right now we're kind of sitting and watching and waiting to see if it will hold or hit above 30,000 and then maintain that level. What most notably, especially for those who would say, all right, well, technical analysis, when we have a different set of parameters than perhaps we've ever seen before, what is the case for the technical analysis, and especially for something that is as volatile as cryptocurrency and Bitcoin?
Well, Brad, I would first of all say that technical analysis is always useful for all investors to have an understanding of trend, and particularly with regards to cryptocurrencies, where fundamentals might be less relevant to how the price moves on a day-to-day basis. Knowing, how price starts to move and how it accelerates, and watching things like momentum and breadth and sentiment are very important. So look, Bitcoin has rallied. It's almost doubled from last November's lows. It's been up about nearly 10,000 points just since March 13th. So that certainly is causing investors to suddenly pay attention at a time when maybe they couldn't care less a few months ago. I would argue that the area right near 28, 29,000 is very important. We've had a very good lift off the lows, but it's gotten a bit overbought. And you look at just daily charts that really show the dramatic surge we've seen in Bitcoin, or we concentrate on just a weekly chart to show that 100-week moving average. I'm looking at things like Ethereum that are rapidly starting to maybe, come back into play and gain ground on Bitcoin after such a big move in Bitcoin in a short period of time.
Mark, good to see you. Thanks for this technical analysis, as you say, useful for many investors. Fundstrat's Global Head of Technical Strategy, Mark Newton. Thanks.